Hello and welcome to Investing Confidential. I got some controversial to talk about here because I know everyone loves the product, everyone loves the company, but there's a real problem with Apple. Okay, a major problem with Apple. And it's not just the fact that you hear on the news that they have problems with manufacturing. We've discussed this for weeks. We've been warning people about Apple's exposure to China because it's not just, they want you to think that it's just the assembly plants, the Foxconn plant, where obviously the conditions for workers are horrific. And now with these lockdown things that have come out, obviously the Chinese government recently, for example, talked about lifting the COVID lockdown on some of the key plants. Like here, you see where the iPhone is put together. Remember, the China is an assembly for Apple. It's not a manufacturer. A lot of them, all the manufacturing is done in places, Taiwan, et cetera. China doesn't really manufacture anything. They just cheaply assemble things. And this is a real problem because Apple, okay, now is using this whole problem with China as a way to cover the lack of demand. Okay, look. You could see here Apple saying they're going to lose 6 million iPhone Pros, because of the COVID lockdowns, etc. Look, folks, the bottom line is, I just went to a local Apple store. They got plenty of phones. Okay, the problem with Apple is demand. It's not manufacturing. It's not assembling and not chips anymore. Okay, I've shown charts in the past. I can show you charts where there's more chips than we know what to do with. There's an overabundance of semiconductor chips. There's too many of them. They overproduced. So, the price of these phones should actually come down because the price of chips are plummeting because there's too many of them. And yet Apple will come out and tell you that, oh, they can't make enough iPhones. Look, folks, this is the same thing that the real estate industry did, the car industry did. They took what was a temporary shortage and made it into a Beanie Baby type of situation where they're making you think like there's a shortage of phones. They want you to run to an Apple store and buy the iPhone Pro, the 14, whatever phone they're making these days. I don't even know. But they want you to think that because they want to create artificial demand, and they're probably going to succeed. But it's not true, because we're seeing this with the cars. We're seeing this with real estate. They bubbled it up, and now everything's imploding. Okay. They can't sell real estate right now. I got a friend trying to sell a house in the Hamptons for 6 months. No bids. Okay. This is the Hamptons. Everyone wants to live in the Hamptons, right? No bids. It's happening all over the country. So maybe there's some isolated pockets, but overall real estate has collapsed because that whole Beanie Baby, that whole artificial syndrome of there's no houses, no one wants to sell. That was baloney, absolute baloney. And they try the same thing with rental. Oh, rents are going to be up. No, rents are down. Rents are going to go significantly lower because of the economy. Again, I keep saying it's the economy. It's not anything else so here's Apple, okay, the $1 trillion market cap company. They got more money. They know what to do with it, generating, and they are, unfortunately, very close. Unfortunately, very close with the Chinese government right now, and they're playing a game that the U.S. consumer is going to feel the pinch. Okay, so I'm not telling you not to buy whatever boycott. No, I have Apple devices. I'm not getting rid of them. They're wonderful devices, but I'm not going to run out and pay a premium or play the game or run out to get an iPhone now, creating an artificial dearth of phones, which doesn't exist. Okay, there's plenty of phones, there's plenty of chips. Don't believe it. Don't believe Apple, because of what's going on. And it's really sad to think that they've resorted to this, but that's basically the reality. So while we're talking about Apple, let's talk about China. The problem with Apple and any company that has exported to China is very simple. China has collapsed. Okay, when I say collapse, I don't mean the government has collapsed yet, but the demand for goods and services, okay, whether it's real estate, whether it's consumer goods, has literally fallen off the cliff because of this zero COVID policy, which, by the way, folks, is not going away. Do not listen to the morons at CNBC. Do not listen to anyone on the internet. You do your own homework. Do search around, go on, see everything, and you're going to see that China has tanks on the streets in certain cities. They're cracking down. They've basically, Twitter is gone. Okay. WeChat, which is that's also been, they are suppressing all social media. Everything's been suppressed. And Apple has participated in that by getting rid of the airdrop. Okay, so they're suppressing everything. And what are they doing? They're going in and they're cracking down. There's no media. Okay, people are taking, you're getting things 3 days later because people taking pictures and somehow trying to get them out through VPNs, etc. But this is a total crackdown. This is a disaster. So from an economic and business standpoint, what does this mean? This means that one of the top three economies in the, I'm not going to call them the largest economy because they're not. Okay, it's artificial. The Europe and the U.S. are still the two biggest, but they're an important part of this. Obviously, globalism, right? This whole thing of globalism. By the way, globalism is gone. Okay, it served its purpose. Globalism was good. There's no reason for it anymore. Okay, we got plenty of globalism. There's a million trade agreements. There's no reason for globalism anymore. But the bottom line is, China as an economic entity is now, not that it's gone, but it's not power anymore. It's literally has dried up. Internally, they got problems. There's no chance of any kind of, everyone's warned about China and the war. Look, all of China's military is in country right now trying to suppress social unrest. They're not out in, they're not, marching towards Taiwan, whatever, getting up. Taiwan is now not going to worry about Taiwan. Right? They got to worry about their own internal problems. So there's millions of troops on the streets, putting up barricades everywhere, which I showed yesterday. This is a nightmare. Okay. Real estate industry, take a look at this. There's no money for it. Now, in the past, China would bail out the real estate industry, just put enough funds. There's no liquidity. They put out some misinformation about the banks. They care about the banks, yes, but real estate is gone. And this is the engine of growth, folks. It has been the engine of growth for 25 years. It's now gone. And until otherwise, it's not coming back. So, you've got all these problems in China with the consumer, with business, and now with the zero COVID. I don't see anything good coming out of it. And again, this is going to affect earnings of U.S. companies and large European companies, large international companies. And it's not going to go away anytime soon. So if you're a U.S. investor, you got that to worry about. Then you got the economy. Here's the terminal rate. We've talked about the terminal rate for a while. We knew it was going up to 5%, probably going up to 6%, okay, at some point. This isn't good, folks, because sure, as we discussed, inflation has peaked, but it's not coming down. It's very sticky. And so the terminal rate is going to stay at this. Now, if you put this in perspective, rates for the last, let's say, have been coming down for 30 years. But for the last 3 or 4 years or 5 years, while we've had this bull market, okay, it's been a really crazy bull market up until 2022, rates were less than 2%, terminal rate 1.5%. I mean, there were nothing. There were no interest rates, right? Almost zero. Now rates are 5% in less than a year period. We still haven't seen the effects of this. This is nasty, okay? Whatever you're hearing about this Fed pivot, I mean, don't believe it. It's not going to happen. Okay, now you can look at here, the business leaders, they're not happy. They think rates have gone on too much. Yeah, they have gone up too much. But the Fed needs to grab their credibility back. They like the fact that people are saying, hey, talk tough, talk tough. They're talking tough. But they also realize they have numbers that they see. They know that inflation is very sticky. And that if they don't continue with this hardline approach, inflation could come back roaring back again. Okay, if the Fed pivoted, okay, tomorrow, in 3 months, we'd be back at 9%. We'd probably be at 9% inflation. Nobody wants that. So the Fed they've got to not only talk tough, they've got to be tough. So forget this Fed pivot. Any rally should be sold based on a Fed pivot. But look at the real problem with this economy. It's retail, okay? Again, we are a retail, consumer-oriented economy. If you look at these numbers, retail is weakening, okay? You can see this. Holiday sales, adjusted for inflation, we're going to be negative like we were in 2008, and we're going lower. Okay, so what you don't understand is this recession we're going to have is going to be worse than 2008. Okay, I'm going to repeat that. This will be worse than 2008. So we're just beginning to fall because the problem is that we bubbled up way too much. So we've got to take off this excess. So we're going to go below 2008, the great financial crisis. We haven't seen nothing yet. Okay, so this is real data. Okay, and look, I saw a lot of these talking heads talking about, oh, this was the greatest, Black Friday, Cyber Monday. Folks, don't believe it. Okay, the only reason that they sold out is they massively discounted. As you can see here, massive discounts across the board. And what does that mean? Okay, so you sold a lot of stuff and the stock market goes up, but then people realize that in order to sell that much stuff, you had a discount and your margins are going to collapse. Okay, you're selling goods at a much lower price, and maybe you're selling more goods, but your margins are collapsing. Okay, and Wall Street doesn't like margins collapsing. Valuations will not hold up in declining margins. So again, I keep going back to the most important thing. It's the economy and the effect on earnings, and the effect on earnings. All of these things is very, very bad. And earnings should be your focus. That's all your focus be. The market is going to go up and down based on earnings. And right now, we are in just the beginnings of a downward earnings spiral. So nothing is going to stop it, okay? Because the Fed isn't going to lower rates probably till 2024 and beyond. They just can't. They just can't at this point. They can stop raising rates, but that's not going to help earnings. Okay, that's not going to help earnings. So we're going to be in this malaise for a long period of time. Again, for 30 years you bought the dip. Now you have to sell the rally. I don't know how long you sell the rally for. Well, it's not going to be just for a year. It's going to be a period much, much longer. So when we talked about earnings, now what the real problem is, or what they're really concerned about, is the bond market. The bond market is in turmoil. Okay. Take a look at this. This isn't a junk bond ETF. This is an investment grade ETF, one of the largest out there, the iShares iBox. We just had the largest one-day outflow in the history of this ETF. This is beyond comprehension. What's going on? There are things happening that I haven't seen in my many, many years trading and investing in companies and investing in bonds. This is something really to be worried about. You don't see this kind of thing in normal markets. This is abnormal, and something like this is very concerning to players, to large investors. And when these large investors start to get out, you need to seriously think. You want to hold for the long term? That's great, but the long term may be very, very long. And I haven't even talked about junk bonds. So that outflow was investment grade. So I think I've showed some charts in the past. The junk bond market is whacked out right now, completely whacked out. We had, up a year ago, we had the tightest, the spread between investment and junk bond yields were the tightest ever been. Now they're widening. They're going to go, they're going to really widen out. But the real problem here, folks, I don't know if you read about this, but our banks, our Wall Street banks are in real trouble. Okay. They went out and they've invested in a lot of risky buyouts and things, proprietary, putting the stuff on their balance sheets. They've got, approximately 42 billion in private. I think it's much more, but they say it's 42 billion, and they need to offload this stuff. Okay. So if you look at this exposure they have, so you got Twitter, and these are all buyouts that have happened that the banks, funded the debt, funded it, for a short-term loan, called bridge financing, and they kept it on their books because they kept it on their books. They're leveraged. They like the yield, whatever. The problem today is that many of these loans are going bad. Okay, Twitter especially going bad. These big junk bond private loans, and these guys have to offload this. They just can't keep on their books. So I'm going to tell you something. I don't know what they're going to do. I don't have any crystal balls, but I'm going to tell you this. The main entities that in the past have bought all this crap were large mutual funds, whether it's BlackRock or whatever. These large junk bond funds, which are complicit with Wall Street. They have been for years. They were complicit during the financial crisis. They took on a lot of these really bad mortgage loans. And if you owned a bond fund back then, you got destroyed. You were cut down by 60, 70%, and you lost your yield for 3 or 4 years. So what do you think these banks are going to try to do? They're trying to package these things together and blow them out to bond funds, et cetera. So be very careful about the bond funds you own. Make sure that it's with a manager who's reliable, that probably doesn't have much cash, because it's the bond funds that have cash are the ones that are going to take on this crap. So just be very careful. Wall Street's going to play games again, and they're going to try to unload this debt on the people that they've always unloaded on. Okay, the big junk bond funds, etc. So it's something that you think you have to be aware about that nobody's talking about. So finally, let's look at something positive for once. Again, we talked about the U.S. being overvalued. Here's a chart. I think I've showed this before. These are, valuations, global valuations. So we look on the left-hand side. Here's the U.S. The little orange dot there is what the current valuation is versus the blue is the range, the valuation range, and the gray thing in the median is the medium. So in the U.S., we're the only region that's at the upper end of its trading range valuation. U.S. stock market, despite coming down, is very, very expensive. And these are 20-year timelines, you can see. So U.S. is very expensive. Okay, and look at some of the other areas where it's not so expensive. You've got Japan, which is very interesting. Why is Japan interesting? Well, Japan is interesting because they have gone through a lot of the pain. Okay, and by the way, their consumer, as you see here, their consumer is in better condition than the consumer in the U.S., the consumer in Europe, et cetera. So the consumer is starting to consume again, starting to pick up. They've gone through, they have lower inflation than we do. They went through, almost a 30-year bear market in their financial asset, coming out of it finally. Inflation actually is good for Japan. I can go into that some other time. So Japan is something to really be interesting, and probably where you're going to see a lot of money flowing to. And then you've got, other places like some emerging markets that look very interesting. I mean, here you see they only cover, broad base, but this includes China, and China is a disaster right now. But you look at places like Brazil, and here again, we talk about the consumer because the consumer is so important to stock markets. Here, the Brazilian consumer is trending higher. Okay, it's coming off a little bit, but it has been trending higher. Where everything else I've showed you in the past, it's trending lower. So Brazil is another interesting place to look at. So overall, the U.S. very expensive. There are pockets of really interesting stuff. I think, as I mentioned yesterday, small caps in the U.S. Japan looks interesting. Places like Brazil, but it's a very, very treacherous environment out there, especially when you have Apple trading at the very highs. It's going to crack, folks, and when it cracks, you're going to get another leg down, a significant leg down on the indexes. So as always, investors, be careful out there.